chapter 11 and 14. So 14 is the one that we recently covered, isn't it? The financial analysis. So make sure you understand the formula and you hafal the formula. You memorize it. Okay? And then definitely they will ask you to do the comment. So make sure you comment according to what we have learned. Yeah. And then chapter 11, we are talking about the preparation of financial statement. Closing entry. So meaning you need to prepare financial statement with adjustment. So remember, I have explained to you the adjustment, about debit and credit as well, but we don't see debit and credit, but we just add. Let's say, is it accrual expenses? We add with the existing balance in the trial balance, isn't it? Of the expenses. Then that is debiting. The crediting is when we put into statement of financial position under current liability. Okay. So if you understand that, so what you have to do, you just plus and then provide in the current liability. So you will be safe. Meaning you just have to memorize the step. So when you do your question, it will be much more faster. If it's prepayment, then you have to minus. So minus is crediting the expenses. So just remember, you minus. Minus, that is crediting. So the debit is when you put into the current asset for expenses. We are talking about expenses. So if it's the opposite, that is revenue, then it will be the opposite way. How do you record? And if we are looking at this guideline, they gave you non-current asset. Yeah, chapter 6 is about non-current asset. So meaning you need to be able to calculate the depreciation using reducing balance method, straight line method. Okay, follow exactly the method that we have in the notes. Okay, if it's a reducing balance method, so you put in a tabular form. So that is, we are talking about the period and then the particular and RM. So in the particular, you put the year. So every year you need to calculate the depreciation. And when you apply the percentage, of course, if we are using reducing balance method, you take the net book value and then times with the percentage. Okay, and then not only calculating but recording. So remember, depreciation, you debit depreciation because it's an expenses, and then you credit accumulated depreciation. Okay, so that is like repeating. So because of this repeating, meaning that will be make easier for you to memorize. And then next one, chapter 7 will be trade receivable. So this one, you need to know how to record bad debts, how to differentiate bad debts and doubtful debts. Bad debts is confirmed debts. Doubtful debts is an estimated of trade receivable likely not making a payment. Okay, so we have for doubtful debts, for bad debts, of course, this is confirmed cannot be collected. So you debit bad debts, remember, just remember, is an expenses. So you debit bad debts, and then the credit is the trade receivable, because you are reducing the trade receivable. Is already confirmed not able to make payment. Whereas doubtful debts, you have increase and decreases. So increases, we debit doubtful debts, we credit allowance of doubtful debts. Okay, if it's a reduction, so we debit allowance of doubtful debts and then we credit doubtful debts. So in that case, the doubtful debts is considered as revenue. All right. Then chapter 8, inventory. So inventory, you must know how to prepare first in, first out, average cost. So we have learned that. And chapter 9, this is year-end adjustment. So year-end adjustment is regarding the prepayment and accrual. So we have, I have shown you the two methods. One method is using one account, isn't it? So that is either an expenses account or revenue account. So you must know if it's an asset. So we have debit balances. Okay, the two-stage method, you have to open two accounts. That is, we try to separate the expenses with if it's prepayment, so is an asset account. Okay, so those are the things that you need to be prepared. Now, oops, sorry. Did you hear me just now?
Can.
Yes,
Yeah.
can.
Okay. So what we do today, so I'm going to show you the answer. Okay, show you the answer. And I'm hoping that you have your hard copy question so that you can refer with. Then I'm just explain the answer. Okay. So my screen will be pointing on the answer only. Yeah. Okay. Let's go through 7 May 2021. You have the paper. Huh? So we the first question. Okay, this one is sole proprietor, every man proprietorship. You have this paper, isn't it? May
Oh, yeah.
2021. Okay.
Oh, yeah.
Okay. So you look at the requirement first. Huh? So the first uh, requirement is prepare the trade payable control account to show the adjustment to the trade payable. So meaning you have, in the additional information, okay, stating, okay, the adjustment about the trade payable. So we have to reflect that into the answer. And then the B part is prepare the statement profit or loss for the year ended 31st of March 2021. So this one, you need to prepare SPL. And then The last one is prepare the statement of financial position. So all these are calculation. So meaning you have 25 marks, yeah, calculation. So if you understand how to do the statement profit or loss and the statement of financial position, so you can, get the answer 100% correct, yeah, if you understand. So there is a possibility to get full mark. Now, okay, if we look at additional information, okay, look at number 6. So number 6, it says it was discovered that the trade payable figures needed to be adjusted. Meaning, if you look at the trial balance, you need to look for the trade payable, which is 25,000. Okay, so remember, it is on a credit column. So meaning this is indicating liability. So if it's liability, as you can see, when you prepare the trade payable control account, okay, the opening balance, okay, which is balance brought down, okay, from the trial balance will be on the credit side. So balance brought down, so we have 25,000. Okay, and that is the first thing you need to do. Okay, record the opening balance. The opening balance, you get it from the trial balance. And it should be credit balance because liability. So balance brought down 25,000. Okay, so this one first. This is the first thing that you need to do to record as opening balance. Then number 6, it was discovered that the trade payable figure needed to be adjusted. Return outward of 2,000. Okay, meaning the business returned the good of 2,000, but did not record in the books. That is the meaning. So what is the effect of return outward? Meaning the business returned the good to the supplier. So it reduced the liability, isn't it? Reducing the liability, okay, meaning it should be debited into the trade payable account. So we record 2,000 on the debit side of the trade payable control account. And the particular, okay, you write down return outward because the double entry is we debit trade payable control account and credit return outward. And cash discount received 450. So all these are not recorded. So we have to do the recording. Okay, once you record this one return outward, so make sure, because whatever you have in the adjustment, okay, you don't have the, oh yeah, I forgot to record this. Hang on, let me do the recording first. Okay, so you whatever that you have in additional information, it is not being recorded yet. So you have to record. So meaning after you recorded trade payable control account, make sure the return upward in the trial balance, the existing. Okay, if you look at the trial balance, you don't have existing. We only have return inward. So we don't have return outward. So meaning now you should record the return outward. So we need to provide it here. So which is this one. Okay. So this is debit. The credit will be when we provide return outward, which presented together with the purchasers, attached together with the purchasers. Can you get the concept? Okay, that is crediting when we provide into the return outward, because return outward is like a reduction of inventory. So therefore, inventory is an asset, so it should be recorded on the credit side. Okay. Then cash discount received 450. So cash discount, what is the double entry for cash discount? Discount received, okay, it will be debited the trade payable, so which is this one, and we credit discount received. It is the revenue. So how do we complete that? So first thing you have to check, do you have a existing discount received in the traveler? So we don't have. So what you do, you just provide exact figure 450 under discount received. Okay. When you provide here as part of the income, this is crediting. So this is credit and this one is debit. And cash payment, 5,000 to trade supplier have all not been recorded in the books. Okay, so this is the payment made by the business. An amount of 5,000 was not recorded. So how do we record? We debit the trade payable control account and then we credit cash account. So meaning to say your cash in the current asset, okay, you have to reduce with the same amount. So this is crediting. This is credit. And where is the debit? So this is the debit. When you provide, sorry, the debit is when you put into the trade payable control account. Okay. So we have done all the adjustment under number 6. Then, okay, we close off the trade payables control account because this is part of the question requirement. Okay, so that is the question required you to prepare the trade payable control account to show the adjustment to the trade payable. So meaning we have to show what is the balancing, what is the balance of the trade payable after all the adjustment. So we do the total line, okay, single, above the total, and then underneath you put a double line, and it must be in the same row, debit, and this one is credit. So we took 25,000, okay, credit total because it is much more higher than the debit side. So use the 25,000 as a total for both sides, debit and credit. Then 2,000 plus 450 plus 5,000. Okay, we cannot get 25,000. So we need a balancing figure. Okay, which is if you minus 25,000 minus 2,000, 450, 5,000, you have a balancing figure of 17,550. So this is what we call credit balance. Credit balance. Why? Credit total is more than the debit side. Okay, how much? 17,550. And this trade payable control account goes to SOFP under current liability. Okay, we provide trade payable here, and the amount is according to your credit balance, okay, which is stated in the ledger account, 17,550. Now, any question on the first part, trade payable control account?
No.
No.
No, huh? Okay, moving on. Now we have additional information. Number one, closing inventory. So closing inventory, meaning after they have done the physical stock taking, so they have, determine how much is the closing stock, which is cost value of 60,000. So how do we do the recording? Okay, remember when we in the ledger account, so we debit closing inventory, isn't it? And then we credit because closing inventory is an asset. So we debit is a debit item. So we debit closing inventory, okay? And then we credit the statement profit or loss. So this is credit here. This is actually on the credit side if we prepare the statement profit or loss in a ledger form. But then we are presenting it in the statement form. Okay, and it is related with cost of goods sold. So therefore, we have to present together with the cost of goods sold. But you see, this is less. Okay, so you less with the expenses. So this expenses is actually.
Do we not call it opening and closing inventory instead of inventory?
So this one is closing.
Can we in the exam can we also just call it
You want to put opening? Yes, can.
opening and closing instead of
Opening
the
inventory and
inventory?
this one is closing.
Can.
Okay. So this is actually credit. Yeah. The debit is when we provide in SOFP under this current asset, 60,000. So we have recorded the first information. So we debit by providing under the current asset, 60,000, and credit when we presented together with the cost of goods sold, but with less symbol. So this is credit. Okay. Now, number two, the depreciation policy of the company is as follows. Building 2% on written down value. Now, the word written down value, meaning the value, the cost, it was minus with the depreciation. So the value is being reduced, being written down to the net book value. That is the meaning. Okay. So that indicates this is reducing balance method. Can you understand? How do we identify it is reducing balance method? So meaning to say, when you calculate the building, so you have to look at the cost. The cost is 250,000. And look at the cumulative depreciation of the building, 10,000. So you have to minus first, 250,000, you minus with 10,000. So you have 240,000 as a net book value. Then you times with the percentage. That is 2% times 2%. So you have 4,800. So by providing depreciation here, 4,800, this is actually debiting. So this is debit. Yeah. When we provide under expenses, debit. And the credit is when we add into the SOFP, okay, under accumulated depreciation. So this is the existing from the trial balance, 10,000, and this is the credit entry. Okay, we plus with the existing, right? And then office equipment, 20% on costs. So this is straight line. So office equipment, you have 20,000, you have accumulated depreciation 2,000, but this is not reducing balance. So the percentage you time with the cost. 20%, 0.2, you times with 20,000. So you get 4,000. So this is debit. by providing as one of the expenses. And then credit is when you add with the existing accumulated depreciation from the trial balance. Okay, plus 2,000 plus 4,000. So that is notes number 2. Now, notes number 3. Electricity yet to be paid was 650. So look at the word yet to be paid, meaning it's not being paid, but it's already incurred. So if it's not being paid, if it's stated not being paid, so meaning that sentence is already indicating to you accrual expenses. So accrual expenses, as what I've said to you, okay, in your expenses, okay, electricity, so you have existing, yeah, from the trial balance, 4,005. So you need to plus 650. So like what I've said to you, when you plus a debit item, this is debit entry, okay? And the credit entry will be when we provide, because this is not being paid, we provide under current liability in SOFP. So current liability, we have, okay, current liability here, accrued electricity. So this is credit. So we complete double entry. And insurance expenses included an amount paid in advance. So very specific, paid in advance, meaning this is for the following year. So what you have to do, okay, you have to reduce your existing insurance amount, which is existing in the trial balance is 2,500. So when you minus 1,000, this is credit entry. So where is the debit entry? The debit entry will be when you provide in SOFP, okay, under current asset, so prepared insurance, 1,000. So far, can you follow?
Oh yeah.
Can.
Can, Farah?
Yes, can.
Can, right. If you cannot, let me know, because then we can try and tackle how to make you understand.
Sir,
Yes,
so the title itself got marks also.
of course. I
Oh,
mean, it is,
okay.
let's say the figure you put there, but your particular, this is particular, we call it particular. If you put wrong particular, like this is prepared insurance, but instead you put here accrued insurance, that is wrong. So
Oh, so no
this one
marks.
is actually 1 mark, yeah, 1 mark. So meaning we divide by 2, so 0.5, 0.5. So if your terms here is wrong, then this will not earn any mark. So you only earn the figure, you only earn 0.5. Okay,
Oh, okay.
right. Next one, number 4. Number 4, the owner has taken 2,000 of inventory for personal use, and this have not yet been recorded in the books. Now, owner, so taking 2,000 worth of inventory, so meaning this indicating a drawing. Whatever type of, whatever owner take out, okay, whether it's cash or whether it's inventory, we call it drawing. So we debit drawing and we credit, because this is inventory, we credit the purchases. So that is the entry. That is a double entry. Do you remember that? So how do you reflect that into the statement of financial position? Meaning, the credit is when you minus the purchases amount here. So this is credit entry, because reducing a debit item, that is, you put on the credit side, isn't it? Okay, so you minus 2,000, that is credit. So the debit is when you provide under equity the drawing. Okay, so you have existing drawing in the trial balance, which is 9,000. So you plus the new drawing from the adjustment, okay, 2,000. This is actually debiting. Okay, debit and purchases is credited. So minus. Number 5, allowance for doubtful debts for the year ended 31st of December is 9,000. It was decided to write off further debts totaling 4,000. Okay, so meaning the bad debts is not being the debts, the bad debts not being recorded 4,000. So we need to record it first, which is, okay, we have the existing bad debts in the trial balance, okay, which is 3,000. So to record the in the additional information, so adding 4,000 here with the existing bad debts is actually debiting. This is debiting. And where is the credit? The credit is when you minus, under current asset, the trade receivable, negative, minus 4,000. So this is crediting. So we have done the debit and credit. Okay. And then we have allowance of doubtful debts. Allowance of doubtful debts. If you look at the trial balance, you have, opening balance, which is 6,000. Okay, 6,000, and compare with the new allowance in additional information number 5, okay, 9,000, meaning you have an increase in doubtful debts. So an increase of doubtful debts, remember, the doubtful debts become expenses. So that is why here, doubtful debts, 3,000, okay, it is listed under expenses. So this is debiting. Debiting doubtful debts. Okay, how do we get 3,000? Compare, this is the new allowance and this is the old allowance. So 9,000, the new allowance is higher than the old allowance, meaning an increase. So increase is an expenses. So where is the credit? And the credit is when you use, okay, in the allowance of doubtful debts, okay, this is credit. Right?
Okay.
Credit, because you don't see, this one is your closing balance of your allowance for doubtful debt. The credit amount is actually the opening, okay, plus with the credit 3,000 just now, and then resulting the closing balance is 9,000. Now, can you get that one?
Oh yeah.
Yeah.
Okay, right? So we have done all the adjustment. So the rest is we just put everything, whatever that you have in the trial balance into the correct place. So which is sales, we have no adjustment, just put it there. Yeah, either you can put on the third column or the second column. And then we have to minus with the return inward. These are the good return by the customer. Okay, no adjustment also, just take from the trial balance. So minus 1,000. So then you have 449,000 on the last column. Then cost of goods sold. Okay, remember we have purchases, but then we have adjustment on the purchases. So therefore we have to use the first column. So uh, do the adjustment first. Purchases, so you need to minus with the drawings. So this is the net, and then less return outward 2,000. So this is the resulting purchases amount, 348,000. Then plus with the opening inventory, okay, less with the closing inventory. So 338 is your cost of sales, cost of goods sold. So make sure, don't forget, this one should be in bracket. So this one we did not put bracket, but then I understand it. But for your case, you have to put a bracket here because otherwise you go and plus. Yeah. So it should be 449,000 less 338,000. Okay, which is sales less cost of goods sold. Okay, so resulting from the equation here, so you will have gross profit 111,000. And then we have add income. So because of the adjustment on the trade payable control account, so we need to include this discount receipt 450. Then no more other income. Then the expenses. Okay, so insurance we have done adjustment. Salary you take as it is from the balance 41,000. Okay, we have adjustment on electricity, bad debts. We have done also the full debts and also depreciation. Okay, then add all together. So the total amount of the expenses is 66,450. Again, you need to put a bracket here. So meaning you have to minus, 111,000 plus 450 less 600, 666, 450. Believe me, it's really so heavy. Let me use
Yeah, very
my
heavy.
Right.
earphone. Okay. Now, so we have net profit 45,000. So that net profit, okay, you plus with the opening capital. So add a net profit here, 45,000. Okay, we have closed off all the expenses and revenue, and we derive just one figure that is net profit, which belong to the owner. So we plus net profit here. Then, first thing we have to do the total asset. Okay, in order to do that, so remember the total asset you have two category, non-current asset first, then followed by current asset. So we have the building, okay, from the trial balance. So there is no depreciation. Okay, so take that amount. Oh, sorry, building we have depreciation. So this is the cost, 250 less accumulated depreciation. Then the net book value. You move on to the second column because this second column is to uh, put all to list down all the category of non-current asset. So then office equipment also the same thing. The net book value you put on the second column. The first column is to do the adjustment on accumulated depreciation. Then, okay, the total non-current asset, then we move on to the third column, 249,200 here. Then current asset, inventory, you put on the second column, okay. We need to use the first column to do the adjustment on the trade receivable. We less with allowance for doubtful debts, 21,000 minus 9,000. Then the net amount, then we put into the second column. So bank, okay, as it is, no changes. But cash, okay, because of the payment made to the trade payable. So we have to do the adjustment and the net is 10,000. and we have prepared insurance just now. Okay, add all together. So you have 251,000 current asset total. So plus with the non-current asset, then this is the amount of your total asset should be the same as equity plus liability. Okay, we have opening capital on the credit side of the trial balance. Okay, plus with the net profit, less with the revised drawing after we have the 2,000 which is not being recorded. So we have recorded it already. So this one you need to minus with 11,000. So closing capital is 407,000. Then in the liability side, so we have only one item, non-current liability, bank loan, 75,000. And the current liability, so we have trade payable and accrued electricity. So when you add all together, so it should be the same as the total asset, okay, which is 500,200. So you should be able to get a balance. If it's not balanced, don't spend too much on balancing it. Yeah. So you leave it and then move to another question. So you only give yourself 20 minutes to do this question on it. Okay. Then the next question, this one will come out. Yeah. So remember the format. So look at the question 2. Peranda Sindran Berhad, a large flour mill has seen a rising trend in the cost of wheat over the last 5 years. So the company processes wheat into flour. So the company adopt a policy of first in, first out for inventory valuation. Okay, and then this one is 1 year. So we have December 2020, so meaning this is the closing balance. And then January 2021, February, and March. Okay, and then look at the requirement, calculate the purchases. Calculate the purchases. So that is why you have to state in your answer this one, calculate the purchases. So how you calculate the purchases? Okay, by adding this value, 1,006 plus this, okay, and then we get 9,360. And then calculate cost of goods sold. So cost of goods sold referring to this column, okay. So you plus this one, 1,520, 80, 1,870 plus altogether. Okay, then you get 8,960. And closing inventory, okay, referring to this, but we don't add like what we did for the purchases and cost of sales, because the balance, the balance column here, we are continuously doing the updating. Okay, every time we have the transaction, we update the balance. After that, until the last March, so we have the last row stating 400. So meaning this is the amount of closing inventory. Okay, we put it here. So that's why we separate it. So 400 will be the closing inventory. So we are fulfilling the first requirement of the question. Okay. Now, how do we record? So because you are given 4 months here, so just do the recording. So December 2020 is the opening balance. So we have 16 price of wheat, and then good received for each month, 100, and good issue to the factory for production of each month in bush shell. So 95. Okay, so we record good receive because the statement in the question is they stated good receive. So meaning this is not the opening balance. So this is indicating the purchases. So we record in the good received, 100 quantity and 1006, okay, the value which come from the price per wheat, price of wheat, RM per bushel, okay. So meaning 16 per bushel, and the quantity bushel is 100. So you times, then you get the value 1600. So we the first thing is we do the first in, first out. Okay. So after we have recorded under receive column, we have to update into your balance column. So 100, 16, 1006. So we just copy. Yeah. And then after that, okay, we have the next column. Yeah. The next column is we have good issue. So we record the good issue, which is you only record the unit first. The bushel is 95. So you record, but before you record, you have to look at what is available quantity. We have only one batch, 16, isn't it? Which is 100. So enough to issue all. So that's why we issue all here, 95. Okay. And we are not recording the selling price. We are recording the cost price here. So we refer from 16 ringgit. So we record 16. Then times, so 1,520. Then you update your balance. So if you have issue 95 with the quantity balance 100, so you minus 100 minus 95, so remaining 5. And what is the cost price? Okay, 16. So 80 altogether. Okay. So in January 2021, so this become an opening balance. So you write down 5, rewrite 5, 16, 80. And January 2021, we have received 120, and the price per bushel is 17. So meaning record under receive column, so 120, but you must put into the second row because the first row already occupied with the balance. Because you need to separate the row. Why? So that you can see which one came in first and which one came in later. Okay, so the second row, you record the receive, okay, quantity 120, and cost price per unit is 17. So total is 2040. You times 120 times 17, you get 2040. Then update your balance. So, okay, same thing, 120, 17, 2040. Right. So the next following, yeah, I mean, in the same month, January, transaction is issuing 115. So we have to issue 115. So before we issue, we need to look the available or existing balance. We have two category in January, so which 16 and 17. So we can only issue 5 for the 16 because this is the only available. So we write down 5, 16, 80, issue them all. And not enough. So we need 100 and, wait, January 115. Okay. So if it's 115, so how much you still need to, if you already issue 5, so 115 minus 5, so 110, we get it from the second batch, which is the cost price is 17. So that's why 110, and then record as cost price as 17 coming from here, and then times, so you get 1,870. Then update your balance. So you have available 120 and you issue 115. So 120 minus 115. Oh, sorry. 5 already issue all. So no more balance here. Okay, no more balance. This one. No more balance. Then we have existing 120. So minus 110. Okay, so we have balance of 10 unit. Okay, 17 and 170. So 10 times 17, 170. Now, so far, can you follow how to do the recording?
Yeah.
Yes.
This part okay.
This one easy, huh?
Easier. I just hope I didn't make a minor mistake. Then
Yeah.
everything wrong.
But not too slow. Huh? Make it faster because you only have 20 minutes for this. Then, because the next following month, okay, this closing become an opening for February. So rewrite 10, 17, 170. Then since the first row is being occupied, so when you record the receive, you start with on the second row. So we have 140 received in quantity, and the price per bushel is 18, and then times, so you have 2,520. Update your balance, okay? So 140, 18, 2,520. So in February, so you have to issue 135 in the question, 135. So you look at available stock. So we have 2 batches. So we need to issue the first one, the first batches 17 because this is first in, first out. So issue them all 10. So since you need to issue 135, so you need to issue 135 minus 10. So need 125 more. So this one comes from the second batch with 18 ringgit as a cost value. So 125 times 18, so 2,250. Then update your balance. Okay, 140, you minus 125, you have 15 left, and the cost price is 18. Okay, so 15 times 18 is 270. Now, March. So this opening, this closing balance become an opening balance in March. So write down 15, 18, 270. So that is why on the receive, so you only record on the second row. Okay, we need to issue 160. Sorry, we receive 160 with the cost price of 20. So you times, so 3,200. Then update your balance. So now we have 2 available inventory. One is cost price 18 and the other one is 20. So in March we need to issue 155. So meaning we have to issue the first batch all of this 15, okay? And then with this cost price 18, so 270. So, but it's not enough. 155 you minus with 15, so you still need 140 more. So this one coming from the second batch with the cost price 20. So 140 times 20, so 2008. Then update your balance 160, you minus with 140, so remaining will be 20 bushel. And then the cost price will be the same, 20%, 20 ringgit. And the value, okay, you just time, so 400. So this is representing your closing inventory, 400. Okay, not adding, and then your cost of goods sold. So this one, of course, you can add because it is not being updated like the balance. Okay, so receive also the same thing. you plus all together, so that is the total amount of purchases. So look at the marks, 18 marks, huh? And then explain any three advantages of using weighted average costing method. So this one we have discussed in, I mean, you have this in your notes. So the first thing, what is the advantage? It could lead to a smoother pattern of cost of goods sold over a period of time. A smoother cost of goods sold would then cause less variation if selling price was based on cost of goods sold. So we are talking about weighted average. We are not talking about the first in, first out. So weighted average is where, okay, we add all the costs, and then after that we divide with the quantity, just to get the average price. So that's why your cost of goods sold will be much more or less is the same, because you whenever we have an issue, we have to do the averaging. So meaning the variation of prices, okay, it was smoothened out. So that is that is the meaning. It could lead to a smoother pattern, okay, cost of goods sold. Now, if smoother cost of goods sold, then cost less variation if selling price was based on cost of goods sold. So meaning your selling price would not like increase or decreases, okay, but it will be consistent because you have averaged it out, okay. And then if the good were not easily differentiated between batches, then mixing them all together using weighted average could be easier. Okay, because it's the same raw material, it's the same brand, but then the only thing is the price is different. So because of inflation. So by using the weighted average, okay, uh, we already put into account all this average cost into the calculated average cost. Okay, so it much more easier. So this is the advantages. So one relevant point, 1 mark. So total 3 marks altogether. Okay, make sure you're able to. Okay, don't focus on the calculation only. The theory part also, you make sure you answer it. Okay, and then C, explain perpetual system of keeping inventory record. So perpetual method meaning it is continuous recording throughout the period. Meaning every time we have a transaction, we immediately do the updating, continuous updating of the bin card, like what we have done just now. This one, huh?
All this still manually do.
Hmm?
All this still
No.
manually do the perpetual method.
Yeah. Yes. You mean this one? Yeah, this is all manually. Is that what you mean,
Yeah,
Kevin?
I just asked one. Yeah.
Yeah. Okay. If the movement of the inventory are recorded properly, the perpetual method can provide. So this is explaining perpetual method. So perpetual method, the first thing you have to explain what is the meaning perpetual. Meaning we do continuous updating, continuous balance. Okay, but I mean updating throughout the period. So we record inflow and outflow inventory throughout the period. And then state, okay, the benefit of doing the perpetual method, which is the movement of the inventory are recorded properly. Okay, the perpetual method can provide accurate balance. Okay, and then even though the perpetual method is very accurate method, they have to still to conduct physical stock count. That is only to ensure, okay, the amount that is recorded in the bin card is correct. So we have to do physical stock count. Okay, and then state the possible reason why during the inventory count there is a difference between what is being recorded in perpetual method and with the actual balance. Yeah. Okay, that is caused by this one, theft. Theft meaning dicuri, and then spoil. Spoil meaning become rosak. Misplacement. Okay, meaning you put not in the warehouse but somewhere else, so misplaced. Okay, so those are the perpetual method, 25 marks or so. Now that is inventory. Any question on inventory?
So can answer in point form.
You mean this one, like this?
Yeah.
Yeah,
Right.
can.
Oh, okay.
As long as you directly state the point is. Yeah. What do you want to say? So this one, okay, normally we need to define them, and then after that, put all the relevant advantage of using that method. Other than that,
The exam, the things, the table, do they give us and then we fill in, right?
like this one table,
Yeah.
yeah, I try lah. I
They,
try to provide.
okay.
But if I being questioned, then I cannot provide.
Okay.
Yeah. Who else? Question 3. Question 3, if you look at the requirement, the question is asking you prepare a 3-column cash book to record the above transaction for the month of March. And then B, prepare the trade receivable and trade payable account for the month of March 2021. So meaning when they state account there, so you need to provide a trade receivable, the ledger account, and trade payable ledger account. Okay, so even though it was not stated in the guideline given, a revision guideline, okay, cash book was not included, but you have to prepare in case it was included in the exam. Okay, so it's important also, you need to know this. Yeah. Now, let's go through one by one. At 1st of March, the financial position of R Singh business showed the following item. So we have cash in hand. Okay, cash in hand, 800. So cash in hand is referring to, this is an opening balance, referring to the cash column. So that's why cash column, okay, we need to record 800 as an opening balance. Okay, cash in hand stated there. So that is indicating balance brought down. So it is debit balance. And balance at bank, 1,000. So that one also an opening balance. So 1,000 under bank column. So that is the first thing we have to record. Now, the trade receivable, okay, John 200 and Peterson 500. Okay, since the question they be prepare the trade receivables and the trade payables. So meaning you have to, because of this plural, receivables and payables, so meaning you have to prepare the account individually, right? So trade receivable John, trade receivable Peterson. And then if you look at the trade payable, okay, so you have Goodman and Rusty. So open up receivable, trade payable Rusty. Okay, trade receivable John, trade receivable Peterson. So remember, trade receivable is an asset. So asset meaning it should be debit balance. So that is why by looking at the question, so you are given the balances, isn't it? So you need to record this on the debit side. So John, okay, 200 will be the opening balance, debit balance. So balance brought down. And then Peterson as well, 500, okay, as an opening balance. So the date, if ending 31st of March, meaning beginning will be 1st of April. So this is not 1st of March. Oh, sorry. This is monthly. For 4 months. For 4 months. Sorry. I'm looking at different questions. As at 1st of March. And prepared for the month of March. So this is monthly. So that's why 1st of March, balance brought down. And trade payable, okay, 600. So credit balance, and then 1,400 for Rusty. Now, next one. The following transaction took place during the month of March. So March 5th, the two customers settled the account by check and received a cash discount of 4%. Okay, so reduction of the trade receivable. Trade receivable. So we need to record. They paid by check and receive a cash discount of 4%. So the prime entry need to be recorded first. Okay, meaning this is payment by the receivable, indicating the business is receiving money. So it should be on the debit side. So record individually. So trade receivable John, and the amount, if we look at John, so we have 200, isn't it? But, okay, John only make payment because it's stated there, by check and receive a cash discount of 4%. So only 96%, okay, out of 200. So 200 times 96%. So the check amount is actually 192 only. So we debit bank column 192. And what is the balance 8 ringgit? So it is under discount allowed. Okay. So at this point, this is a prime entry. So single entry only. This one is prime entry. So when we record in the trade receivable John, we record it as a single entry. So 192. So this is reducing of a debit item. So that's why we need to do a credit entry in the John. Okay. And then we have to credit 8 ringgit as a in the trade receivable John. In particular, you write down discount allowed. Okay, resulting from this transaction, so it is settled. 200 credit, yeah, this one credit, and then 200 debit. So same amount, huh? So no more balance CD and balance BD. Peterson. Okay, also the same thing, which is given 5% discount. So 5%, not 5%, 4%. Okay, 0.96 you times with 500. So you have 480. So prime entry will be record in the cash book and the bank column 480. And the different, okay, which is 20 ringgit, also consider as discount allowed. Okay, and then record in the trade receivable Peterson, so single entry, because this is, you're talking about sales ledger here, sales ledger and purchases ledger. So we credit 480 in trade receivable Peterson and credit 20 as a discount allowed. Okay, so the account is settled. Debit 500, credit 500. Okay. Any questions so far? March 5th, done.
No.
Okay. Okay, March 10, a check for 115 was cash for office use. A check for 115, meaning your bank reduced. So bank will be credited. Bank column credited 115. So this is contra entry. Was cash for office use. So the particular, you write down cash here. And don't forget to do the double entry. Okay, that is debit cash column 115. And the particular, so we put bank. Contra entry. Don't forget this indicator. Okay, 15. The amount owing to Goodman was paid by check less 7.5% cash discount. Okay, the amount we check, Goodman 600. So meaning the 600 is the invoice amount. So we need to find what is the check amount. The check amount would be after you minus the 7.5% cash discount. So 7.5, okay, if it's 100% minus 7.5, so you have 92.5. So 0.925 you times with the invoice, I mean the opening balance, 600. Times with 600. So the amount, okay, the check amount that is being paid is 555. So you need to record in the prime entry, cash book, okay, record in the bank column, 555. And then the other 45 is a discount received column. Okay. Rusty account was settled by check subject to discount of 5%. So meaning only 95% is the amount of check. So we look at how much Rusty owing, how much the business owing to Rusty, 1,400. So 1,400, okay, times 95%. So 1,330. So record in the payment side, on the credit side. And then record the difference, 70, into the discount received column. And make a single entry in Rusty and Goodman. Or only Goodman first. So Goodman, 555, and then 45 for the discount receipt. Okay, this is single entry. Now on the 18th, so Rusty account was settled by check subject to a discount of 5%. So same thing, so which is prime entry, okay, under the payment side on the credit side. So 1,330 and 70, okay. So and then complete the double entry, not double entry, a single entry in Rusty. So 1,330, okay, and discount is 70. And the last one, okay, wages of 165 were paid in cash. So meaning in the cash column on the credit side, this is cash column 165, yeah? Okay, it will be wages. So you were not asked to open up wages account, complete the double entry, no need to do. So just record it in the cash book only. So we have done all the transaction. Then we close off. So for the cash book, the bank column, the debit, yeah, is more than the credit side. Sorry, this one is credit is more than the debit side. So that's why you have credit balance, credit balance. So credit 2,000 is more than the debit side. So that is why 2,000 minus 1,000, 192, 480. So you get 328. So meaning this balance is a credit balance, total credit more than the debit side by this much. Okay, so that's why you have credit balance. But for cash, must be debit balance. So debit side more 915. So use that total as a balance in the credit side as well. So minus 165. So this is the balancing figure. So this is debit balance. Okay. CD above the total on the credit side. So we look at BD below the total. So it is on the debit side. So debit balance. Prepare, so done. Now, the B part. We are given there. Suppose a company has an existing allowance for doubtful debts. Okay, this is the kind of question they will ask also. Okay, this is like a theory. Okay, meaning you have to explain it in wording. So suppose a company has existing allowance for doubtful debts. In the new financial year, they have an increase in trade receivable. And this means the more customer could end up as a doubtful debts. So explain the effect of increasing allowance for doubtful debts in the financial statement. Explain the effect. We're talking about the effect. So to increase the allowance of doubtful debts, one would need to charge as an expenses to doubtful debts account. So meaning we are explaining how we do the recording in the ledger, okay, in wording. So if there is an increase allowance of doubtful debts, so meaning we providing an expenses, okay? So we debit doubtful debts. And then this, the effect is it would reduce the net profit. Okay, why reduce net profit? Because doubtful debts, if it's increase and expenses, isn't it? So that's why the net profit will be reduced. So you are telling the possibility of explaining this question. Suppose the company has existing allowance, explain the effect of increasing allowance. So you also need to uh, explain what happens if we have decreases. An increase of allowance for doubtful debts will reduce the trade receivable, hence reducing current asset. So all about effect, isn't it? If we have increase in allowance, so that would increase the expenses. So therefore, it would reduce the net profit. And then if increase in allowance of doubtful debts, what happened to the trade receivable? The trade receivable, because in the current asset, you have the trade receivable, you need to minus the allowance of doubtful debts, isn't it? So if increase in allowance of doubtful debts, definitely the amount of closing also increase. So that is why this statement happened. Next, an increase in allowance would reduce the trade receivable because you need to minus, isn't it? When you present it in the SOFP, okay, and the current asset, so trade receivable less allowance of doubtful debts. Okay, so therefore reducing total current asset. So that is the effect. Now, B, suppose a company was choosing between straight line method 20% and reducing balance method 20% for the depreciation policy. Compare the above two methods over a period of 5 years. Okay, so meaning you are explaining what would be the effect if we are trying to distinguish between straight line and reducing balance method. So if it's reducing balance method, from year 2 to 5, reducing balance would show a decreasing amount as each year passes. So that is the first difference, meaning you are explaining the difference between these two methods because the wording there compare the above two methods over a period of 5 years. Okay, in the first year, the two method would give the same depreciation amount. Yes, it's true because the first year, okay, for reducing balance method, the percentage they apply with the original cost, you times with the original cost. Same goes with straight line, isn't it? But thereafter, from year 2 to 5, so the amount, okay, because we are using reducing balance method, so we base on the net book value, isn't it? Okay, would show a decreasing amount as each year passes by. Whereas straight line method would show the same amount of depreciation every year. So it's the same amount because the percentage you times with the original cost. But reducing balance method, the percentage you times with the net book value, which the value is reducing from time to time. So that causes the depreciation also decreasing amount. Okay, that is the answer for B. Compare cash transaction and credit transaction. Now, cash transaction, of course, this is cash sales. Let's say you have to put the imagination into one particular example. So let's say we're talking about sales. So cash sales meaning, okay, you get the payment immediately. Okay, so cash transaction would involve the cash book. Cash book will be the prime entry. But credit transaction it doesn't involve cash book. So it will be credit. It will be in the sales journal or purchases journal as a prime entry. Okay, and then after, the figure would be transferred to sales ledger or purchases ledger. Okay, and then a credit sales or credit purchases total for the month will be transferred to the sales account or the purchases account. So we are talking about cash transaction, yeah, and then credit transaction. So we are comparing the final credit sales or credit purchases total for the month would be transferred to sales account or the purchases account. Okay, meaning we debit the trade receivable and then we credit the cash, isn't it? The final credit sales or credit purchases total, sales account and to the purchases account. Now, is it clear, this one? The difference between cash transaction and credit transaction? Cash transaction, meaning immediately you will have the money, okay? But credit transaction, they will defer the payment according to the credit.
Also in table form or must use in sentences?
In point form also
If they
can,
ask- if they ask-
acceptable.
If they ask for
Mm.
the difference, like you do table form, can get.
Table form can also, lah. Yeah, can.
Okay.
Okay. Now the last one is this is what I'm saying to you. You have to show. Okay, you put in columnar form. Okay, show the first column will be showing the formula. It will be given marks, and then after that, show the calculation and the result.
Oh, this one last chapter one.
Yeah, this is the one that we had. So if you look at question 4, you are given, because if you look at the requirement, the question wants you to find gross profit margin, net profit margin, current ratio, quick ratio, inventory turnover days, trade receivable days, trade payable days. Okay, so gross profit margin. So take the gross profit and we divide with the sales and times 100%. Yeah. So looking at the question, so the gross profit is 99,000 divided with 434, okay, times 100% for year 2020. Then 2021, okay, the gross profit is 129 and the sales is 596,000. Then you times with 100%. So we have 21.6%. And then 2020, 22.8%. So meaning 2020 performed better. So meaning the performance of the current year is, dropping. Okay. So net profit margin, okay, get the net profit, divide with the sales. Okay, times 100%. Okay, for current ratio, current asset, we divide with current liability. Okay, make sure you know where to get the amount, current asset. If you look at the question, is 203. Right? In 2021, 196. Now, how to calculate? I think you have no problem, isn't it? Getting the figure also no problem. But the only problem will be the comment. Okay? So if we look at the comment, so you have to compare this one. compare with the calculation, and then you do the comment. So let me read the comment first. So by looking at this answer, gross profit margin. So gross profit margin, so focus on the current year first. This is current year, this is previous year. So as you can see, the resulting percentage, yeah, smaller than the previous year. So meaning to say, the current year gross profit has dropped, yeah, has dropped comparison with the year 2020. So that is, I mean, you already earned mark just stating that. Okay, and then although sales has increased for 2021, yet the cost of goods sold has increased in tandem, leading to a slight drop in gross profit margin. So we are giving the reason, okay? The reason why this is a slight drop, okay, because of the cost of goods sold during the current year increases. Okay, so this is your cost of goods sold. Increase in sales, but then the cost of goods sold also increase. Okay, so that's make, you know, when we divide, okay, the percentage resulting from the gross profit margin, okay, much more lower comparing with the previous year. Okay, so this is what happened because of if you look at our notes, due to higher cost of goods sold, isn't it? That is the reason. So this one is more or less the same thing because of cost of goods sold increases. Okay, what about net profit margin? Net profit margin current year is 3.9 and then previous year is 6.5. So meaning drops also drop. Then you should state what is the reason. So the reason being the increase of the expenses, yeah, as the sales increases. So follow from your notes. And then next one that is requested by the question. So current ratio. So take the current asset, okay, and look at this. For the current asset in 2020 is 3.2 to 1. So 3.2 asset, 1 ringgit of current liability, they have 3.2. And in 2021, they have 1.6 to 1. Meaning there is, you know, look at the asset here, 3.2, but now is 1.6. So meaning a decrease in asset, isn't it? A decline in current liability because decline probably because of the current asset drop from 3.2 to 1.6. So but still they can cover current liability. So it's still not indicating any liquidity problem. So then probably you can look at the component of the current asset, the current liability. So you look at what is the significant changes there. Okay, you have, you know, in 2020 they don't have any bank overdraft, but suddenly during the current year they have 47. So probably because due to that. So unusual, isn't it? Okay, so you put into your answer. And in the terms of quick ratio, okay, that is we have to less, yeah, the inventory. So 203 minus 70. The current year 196 minus 86. And last time, previous year, we have 2.1 asset for 1 ringgit of current liability. But during the current year, dropped to 0.9 to 1. So meaning you have to state the first thing, there is a drop, okay, of the current asset, okay, in the quick ratio, yeah, in the quick ratio. And what would be the possible reason? Okay, because of the significant increase in closing inventory. Yeah, initially previous year is 70, and then the current year is 86. Okay. Then efficiency, the inventory. Okay, inventory turnover in number of days. So remember, average inventory divided with cost of goods sold. So average inventory, can we find the average inventory? Okay, for 2020, you have you cannot see, yeah, you cannot see the opening inventory and closing inventory, isn't it? Because opening inventory for 2020 you cannot see, but then the opening inventory for 2021 you can see, because this 70 become an opening inventory for 2021, isn't it? But then we don't, I mean, to be consistent, okay, so the average inventory, what you have to do,
We just take the
oh,
closing.
sorry, this one given, you have this.
Oh, okay.
Yeah.
If there's not that one, we just take the closing inventory.
Yes, correct. Because we have to be consistent. But since you are given this information here, so 31st of March 2019, so meaning you have an opening inventory for 2020 also. So you can use this, okay, to get the average inventory. So the calculation here, 68 days. Previous year. Current year is 61 days. So meaning indicating during the current year, okay, they are more efficient because they can sell the inventory much more faster than 2020. So that is your comment. And for the trade receivable, okay, we have 67 days the current year, 83 days previous year. So you comment, okay, meaning your collection period also improving, yeah, from 83 days become 67 days. So meaning they have improvised the collection system. Okay, and then the last one, the trade payable. 57 days and 66 days. So improving, shorter time period. So that's all. That's all how you do the comment. So the comment, don't leave it blank. So you have to do the comment accordingly. Yeah. So follow the guideline that we have in the notes. Okay, class. So we only managed to discuss May 2021 only. So I think, Miss Chan gonna have class with you 2 classes, isn't it? So she would, I think, continue with this, is it?
Should be more than one class. I think next week, yeah, we haven't chosen which past year to discuss yet.
Oh, so meaning we have discussed the May 2021. So now you can discuss the September 2020 and what else given?
There's 4 past year.
4.
Yeah, there's 4 of them. There's the May, there's February 2019, and then September 2020, October 2021.
Okay. So now, do you have any question on this May 2021?
No.
Okay. Can you understand?
No, now I see the answer. Okay, but the first question should be very hard for me lah, because the additional information I still not that good at turning
Yeah.
it into. I still not good at the doing the additional information.
Oh,
Yeah, that one.
but can you understand
Uh,
plus and then after that provide in the SOFP?
yeah, that one I can understand. Just just
You understand
when
when I
need to,
explain, but then when you actually doing it, you
I
get confused.
I get confused if I need to plus or minus or which one is the debit credit side. That mostly the plus and minus thing lah, based on the additional information. The credit and debit are also a little bit maybe might be do wrong some when I do the ledger.
Okay. You see, the thing is, first thing, if it's expenses, so it's a debit item. If it's revenue, it's a credit item.
Yeah, that's so far my like following that logic. I just afraid I do wrong.
Oh, so meaning, if it's accrued expenses, okay, you need to plus. So remember in your notes, you have a table there. If it's accrued, so you plus. If it's prepayment, you minus. SPL, you plus. You have in the notes actually.
Yeah, I got that. I just when I do I afraid I waste too much time trying to think which one is which. Yeah.
That's why in the exam, what you have to do, you use the table as your guideline.
Oh yeah, the table.
Yeah. The only problem is, do you be able to identify which one is accrued, which one is prepayment on it?
Yeah.
So that will, I mean, that will make you move much faster. Okay. So let me know until what what past year question you have covered with Ms. Chan. If need arises, then we do another class.
Yeah, got a lot
Okay,
of time.
because you're having on Tuesday and Wednesday, isn't it?
Oh no, Monday and Tuesday we got exam, and then one more week is the next week is the next Monday is the this one finance accounting.
Oh, okay.
So a lot of time to can do revision.
Okay. All right. So I'm not going to take much of your time. So you can do revision after this lah. Okay.
Okay.
All right.
Thank you, sir.
So good night. Hey, what happened to Farah? Farah left, huh?
Oh, I don't know.
Okay. What time she left? I mean, he left.
I think it's a few 10-20 minutes ago. I think.
Oh, okay. All right. Bye. Good night.
Thanks, sir.